December 2018. Let's bring in Jason Trennert, chairman at Strategas, a Baird company, and Jim Bianco, president at Bianco Research. Gentlemen, good to have both of you. Jason, how are we set up for earnings season, given that Treasury yields continue to rise on already high levels?
Listen, I think, Sarah, at this point, it's, in my opinion, the path of least resistance for long-term interest rates is still higher. I think it's important to remember that the Fed has only tightened 25 basis points, and their preferred measure of inflation is at about 5.5%. The CPI is about 8.5%. So there's a long way to go. And from our perspective,
yeah, but the market's pricing in 8 or 9 hikes. Isn't that already in the market?
Well, that's in the bond market. I'm convinced it's not in the stock market at this point, because I think there are a lot of tech issues. There are a lot of stocks trading at a multiple of sales that, in my opinion, are not going to be able to withstand significantly higher interest rates. I think we're at a point now, as we transition from quantitative easing to quantitative tightening, where capital is going to be rationed. I think we had an everyone gets a trophy cost of capital for about 13 years since the last financial crisis, and I think now it's going to be a little different.
Jim, what about you? You feel that rising rates are going to be a big headwind still for stocks?
Oh, yeah, I think that they are, and I want to underscore what Jason just said, too. The bond market is pricing in 9 or 10 rate hikes for this year, depending on how you measure it. And that's specifically the short end of the bond market, like Fed fund futures traders, T-bill traders, repo traders. But when you move out to long-term bonds and you move out to equities, most of them think the Fed's going to go 4 or 5 times and then stop. And they're in for a surprise if that's what doesn't happen. And I think the Fed is fully intended on being every bit as aggressive as they say. So as rates move higher, it is going to become a bigger and bigger headwind. And what I'm just trying to say is, no, it's not priced in that we're going to have aggressively higher interest rates.
So, Jason, what do you do in this environment? Because you do have some parts of the market working this year against this backdrop of rising rates. Yeah. Energy keeps going higher. And then you've got some of the defensives working well, like staples and healthcare. Not today, but in general. What's the playbook?
Right. So I think the playbook, Sarah, it's not that different than the playbook you might have in bonds, which is to say that for stocks, you want to be in shorter duration equities, which is just a fancy way of saying you want companies that are throwing off cash, either to buy back stock or to pay dividends. The companies that don't generate a lot of cash, that can't return money to shareholders, in many ways act like zero coupon bonds as long-term interest rates rise. They get killed. So, in my opinion, the sectors that we like the most right now are energy, basic materials, industrials, and healthcare. I think you do have to be more selective as interest rates go higher. There may be some other industry groups in some of the other sectors, like regional banks and financials, but I think you just have to tread a lot more carefully, probably hold a little bit more cash, and again, really stick with higher quality companies that are going to turn money to shareholders as a hedge against inflation.
Jim, what do you think we're going to learn this earnings season? The optimists are saying companies are actually in pretty good shape. A lot of them have pricing power. The consumer's been doing fine, and it could be a positive catalyst. The pessimists say, actually, we've seen margins peak, and the outlooks are going to be pretty dire. What do you think?
You know, that's a good question. Right now, if you look at what company guidance is giving us, it's a little bit more dour, that they're worried about the future, and the word inflation comes up a lot in word searches of the conference calls that we've been getting as of late. But I will tell you who's looking at it very closely, and that's the Federal Reserve. Bill Dudley wrote an op-ed. He was the former New York Fed president about 2 weeks ago, where he said if the stock market doesn't go down, the Fed might have to lower it. And he's suggesting that the policy of the Federal Reserve is going to be to try and create some kind of reverse wealth effect to help rein in inflation. So be careful if we get good earnings numbers, because that might just encourage the Fed to go 50 every meeting as opposed to 25.
That.
Oh, I absolutely buy that.
Governor Waller was on the show, and he pushed back. He pushed back against that. Says we don't need to shock the market. The whole point of forward guidance is to lay the groundwork for higher rates, which will do the job to put pressure on demand in the economy, that without doing any kind of stock market shock.
Well, the part of the stock market shock is they have to show that they're intending on doing that. He can't just say that because the market won't believe him. Again, that gets back to that whole idea we got 10 rate hikes priced in. But if you look at surveys like the Bank of America Global Fund Manager Survey, most of the managers don't think the Fed's going to go anywhere near that. So for Governor Waller to have the Fed do what you want to do, you got to be prepared to go 50 every meeting because it doesn't believe you are.
Jason, you think the Fed has to push back against the market strength? Not that it's been that strong.
Well, listen, I think the main thing is the Fed can't worry about what the market is doing. It has to fight inflation. And so the Fed put that we've become so accustomed to really since 2008, in my opinion, is deep out of the money. I don't think the Fed has the luxury of forecasting inflation anymore. It must fight inflation. It has to play the ball as it lies. And right now, it looks like the Fed's lost control. And I think the only way they get control is by being aggressive. This is also a midterm election year. And so I think that's also an important moving part in this, in that inflation is it does seem to be out of control. It is atop most of the surveys of both businesses and consumers. And the Fed has to protect its own independence. So it's going to have to get involved, if only to protect its own reputation.
Jason Trenner, we'll leave it there. Thank you. Jim Bianco, always good to see you as well. There go the gains. S&P 500 up 2 points. After the break, Bank of America and Charles Schwab moving in opposite directions today after a